Marcellus Investments. Pramod, afternoon. Good to have you. We are chatting after a long time. I know, we are not supposed to talk near-term direction of the market, but we are just trying to map the factors which are at play. The sudden change of stance from Fed last evening has triggered a big global risk-on moment. India is also participating. Is it really something which the market is surprised from? Or it was largely in the direction market was expecting, but it came suddenly, 3 hike possibility now on the table starting mid next year?
Yeah, no, I reckon it's not a total surprise. If you see, I think pretty much beginning April of this year, and the best indication has been either the dollar index or FII flows into India as well. We pretty much bottomed out in terms of FII outflows sometime in March 2023. And I think it was the 25th March 2023 Fed meeting which sort of triggered that. In some, the market started factoring in that we are close to the peak of the interest rate cycle, if not foreseeing some cuts. And that has been at play for quite some time. In fact, over the last month or so, November, we saw massive FII inflows. Throughout that period, it's actually an anticipation of that. We also saw a significant drop in bond yields in the US to the tune of almost 60, 70 basis points within a period of a month. So to that extent, I don't think it is a complete surprise. The market has been anticipating this. What we heard last night was just a confirmation of that. They were already probability built for March and a June rate cut for 2024. I think the probabilities have only just gone up. To that extent, this news is incremental, but it's certainly positive. FII flow should sustain more from this interest rate perspective, but also I think India stands to benefit more disproportionately as we get a larger share of allocation to risk assets like emerging markets, given the relative unattractiveness of China, at least from the foreign investor standpoint. And therefore, we should get a sort of a double benefit, the cyclical benefit of rates topping out and also getting a higher share of allocations to emerging markets.
Pramod, is it justified, to assume that both the PEs in India and EPS of India both have tailwinds now?
The PE is something that depends on several factors. Most of them are not in our control. In fact, not predictable as well. 4 years ago, we saw the most unforeseen risk in the form of COVID. A couple of years ago, it was Ukraine triggering commodity rally. So I would hazard that we should invest basis an expectation of PE expansion. The PEs have always been on the higher side relative to other emerging markets, and justifiably so, given the quality of Indian companies in the index. Our ROCs of the index constituents are significantly better than other markets. Our predictability of growth, particularly over the last 30 years, has been significantly better than any other emerging market. So quality of companies, the growth prospects, and the predictability of growth means that we do deserve that premium. But to the extent that we are already at that 23, 24 times sort of multiple, we are somewhere close to that median in terms of cross-cycle average. Cross-cycle range has been around 17 to 30. So to that extent, I don't think we have a massive tailwind on the PE expansion. We should expect the earnings growth to do much of the heavy lifting in terms of generating future returns. In that case, the PEs will also sustain. The PEs will also be a reflection of underlying fundamentals. But I think we are in a very strong position for earnings growth to pick up. Perhaps we are in the best time in almost 15 years in terms of looking forward to an investment cycle. The government has done a lot of heavy lifting in terms of capex through public infrastructure. It's about time the private sector jumps in. We're seeing the beginnings of that, and we know that these cycles tend to last 3 to 5 years. And that can have a knock-on effect on other components of the economy. With private capex picking up, you'll see job creation. Job creation should result in income generation and consumption also getting a boost. So the reason we are so positive on the private capex cycle is we've seen all the boxes getting ticked after a long time. The banking system is at its strongest shape. We're seeing capital adequacy ratios of 17%. I don't know after how long. So therefore, to the extent you do need to provide credit support to the economy for capex growth, we have the financial system geared up to doing that. We've also seen a period of deleveraging in terms of corporate balance sheets. They are in a position to lever up again and start investing into capacity expansion. And thirdly, we're also seeing a structural drop in cost of capital. One of the sort of impediments for Indian manufacturing to take off was we lost out both on the labor and capital front in terms of cost competitiveness. But through various factors, including, say, financialization of savings in India, where lots of money is coming into financial products, has meant that in this cycle of interest rate hikes, India has lagged in terms of, say, the 10-year bond yields going up as compared to the US bond yield. To that extent, spreads, I reckon, have structurally narrowed, which means
Oops. I think we've snapped that line. So we'll try and get back to Pramod in a minute from now. Let's take a look at how some of the components of this gain actually are. PSUs, Indian PSU basket, if you pull up the PSU gainers, clearly stocks like IRCTC, Hudco, all of them, not only PSU banks, but the PSE gainers, the public sector enterprises beyond just the banks also is witnessing some big rally which is happening right now. So the complexion of rally, just let me also tell you that IT clearly is one of the biggest gainers in today's session because of one, beaten down sector, the other, NASDAQ is staging a big rally, and high growth sectors are one of the biggest beneficiaries of any improved outlook as far as rates and rates are concerned. Okay, Pramod is back with us. Pramod, we snapped that line, but I would like to quickly get your thoughts on the earnings momentum from here on, because everybody is questioning that from here on, if the earnings momentum continues, only then this rally is actually justified. How's the outlook looking of your portfolio companies when you speak to them post the earnings season? Do you think earnings momentum in India is largely on track?
I think these things always work in pockets. Of course, the domestic economy, like I was saying, those facing the capex cycle as a growth driver, we're in a pretty strong position in terms of calling for the earnings momentum to sustain. Certain other sectors are facing some headwinds, particularly those facing the global economy. Say, for example, IT services. We still don't know when BFSI, which is the largest customer segment for the industry, is going to recover and start spending on IT. But these are perhaps cyclical issues which will always favor one sector over the other. But I think if you take a look at sectors facing the domestic economy as a whole, particularly with a little bit of bent towards the capital cycle, I reckon earnings momentum is pretty strong. With a little bit of a lag, like I said, with job creation, we will get a fillip to consumption as well. Consumption has sort of slowed down in terms of earnings momentum, both on the staple side as well as discretionary side. But it will be a big beneficiary of the capex cycle eventually. But for this moment, I think the industrial space, the financial space, which are linked to the cycle, you are seeing significant confidence in the earnings momentum sustaining.
What are your thoughts on flows? The way macro triggers are placed now, global dollar index has collapsed, US economy and China both on a weak footing, and bond yields are coming back. And FIIs have actually alluded, one large pocket of FIIs have been out of the Indian market. Do you see India dedicated funds or even FIIs in general who look at EM allocate bigger flows in 24, in which we were missing in the last 1 year? Could that be the case?
Absolutely. I think there's a very, very high probability of that happening because historically, most large allocators to India have preferred to invest through emerging market funds. And India was somewhere between 8 and 15% in terms of weight of emerging market indices. But their primary objective was to get exposure to China. But to the extent that China has disappointed both in terms of returns as well as the sort of unpredictability of policies, there is clearly an inclination towards allocating more towards India than China. So to that extent, India dedicated funds become more attractive for them because if you invest in emerging market funds, you'll get 35% exposure to China anyways. So which is what you are running away from. To that extent, I would expect significant allocations towards India dedicated funds. Several of these allocators are looking at India for the first time. It might take some time for them to get a grip on valuations because the first thing that they would be surprised is that like 24 times at the index level looks like a lot of positives that we know about India is priced in. It will take a while for them to make peace with that. And when that happens, I expect significant flows to come into India, largely through India dedicated funds. Maybe on the other side of elections, perhaps because that's the only bit of uncertainty. Maybe the last week's state elections has ironed out uncertainty a little bit. Allocators would like to see some political stability. So maybe the big ramp up might come on the other side of election, but we've already seen the beginnings of those starting with last week's flows.
Excellent point, Pramod. That was the only point I perhaps missed touching upon, and you have included that in your answer. Great to have you, Pramod.